This conference will now
Welcome
be
to the
recorded.
SIA Wealth Management Advisor Update for May 2025. My name is Colin Cieszynski, Portfolio Manager and Chief Market Strategist. Thank you very much for joining us this month. In this month, we're going to take a look at some of the recent changes in the economy and in investor sentiment. We continue to see quite a volatile 2025. We've had a lot of negativity, and we've had some big rebounds as well, and big swings in the markets in both directions. And we'll give an update on some of the recent performance and changes in relative strength in across global markets. And we'll finish with an update on our portfolios and some of our recent performance. To start off with the economic overview, I think most of us realize that the political and economic environment right now remains very volatile, and it's been volatile throughout this year. But there's also some encouraging signs as well. The tariff war, which had worsened over the winter and put a lot of pressure on equities, has dialed back a little bit. The U.S. reached a trade deal with the U.K. They're talking to other countries. The U.S. and China have paused and dialed down their retaliatory tariffs. They're still talking, but results are not guaranteed. So there's been, and that's why I call it encouraging, because there's been signs of improvement, but we're not completely out of the woods yet. And we still could see some negative things out there as well. U.S. GDP was negative in Q1. If we have another negative quarter, that would technically be a recession in the United States. So it's something we're watching for. This week, the biggest news has been that the U.S. credit rating was recently downgraded by Moody's, and that confirmed downgrades previously from other agencies. So there's still some risks out there as well. The 10-year Treasury note is hovering in the 4.25 to 4.5 range. It's actually been starting to peak up above 4.5%. On the positive side, we've seen China and Australia both cut interest rates this week. So there are some concerns out there about economies in other countries. At the same time, that also helps to boost liquidity, and we have seen a rebound in Chinese markets, particularly of late, and in the Australian dollar along with the Canadian dollar. Recent inflation reports from several countries, including the U.S. and Canada, have been benign so far. Inflation has remained relatively contained. We haven't seen a huge acceleration yet. We're still continuing to watch that. And earnings and guidance from corporations was mixed, but overall not as bad as feared, considering if you had a negative quarter of GDP, that it wasn't quite as bad as it could have been. And we're seeing here in our SIA charts equity action call, which is a measurement of global equity market risk, money flows, and price action changes relative to alternative asset classes. So during the winter, we saw the relative strength of equities decline, particularly relative to cash. And in recent weeks, we've seen it come back extremely strong. The markets have been very strong, and in particular, the U.S., which underperformed through the first several months of this year, has bounced back quite rapidly. And here's an example of this in the last month. We can see that everything is positive, pretty much. The weakest was Saudi Arabia at essentially flat, but we've seen gains for the United States, gains for China, gains for a number of countries in Europe. Most recently, the DAX has hit a new all-time high. In Germany, the TSX in Canada has hit a new all-time high recently. So we've seen a rebound in the States, but we're also seeing broad strength across the world, and with Canada and international equities also doing very well. Year to date, it's kind of similar, but a little more mixed. There are a few negative countries out there, and the U.S. performance year to date has not been as strong relative to recently. It got knocked down more, so it's bounced back more. Looking at a change in our sector scopes, if we look back a month ago, it was fairly balanced across the spectrum. And what this means is this is the bullish percent of 31 industry groups, essentially level 2 type groups. And we look at what percentage of the stocks are in that group are on bullish signals. And normally in a normal kind of market, you would see it something like this, where there's a large cluster in the middle around 50-50, and the extremes, the low end on the left and the high end on the right, not so many. That's your tails. And so that's somewhat of a normal balanced kind of market. Some sectors are doing well and some aren't. Now what we're seeing is that all the sectors have piled up on the right-hand side in the two rightmost columns. So that's essentially 80% or above in bullish percent. And so that's an extremely strong market. It means we've been in a very strong bull market for the last month, and we may be starting to get a little bit overbought, which is probably why we've seen markets start to pause a little bit over the last couple of days to consolidate their recent gains. Also important here is if we look, we can see that the kind of the defensive sectors are now lagging, and some of the growth and cyclicals are among the strongest. So if we look at the rightmost columns, we can see financials like banks are in there, but some of the previously depressed sectors that were tariff impacted, autos, electronics and semiconductors, transports, they're all now up at the top and at the rightmost side. And some of the other cyclicals like leisure, computer hardware, things like that, also very strong. If we look here on what's dragging metals and mining is because we have seen weakness in gold lately. Gold was defensive, and now that investors are getting more aggressive, they've been rotating out of gold. So no surprise, its bullish percent from metal miners is lower. But then we look at all the rest are defensives: food, drugs, utilities, healthcare, and wholesale. All the defensive sectors are now the ones that are lagging. They're the ones that are seeing capital rotating out and capital going back into the more cyclical momentum type sectors. Looking at seasonality, we're a little bit off of the historical averages this year. Historically, we kind of, if we look at the blue bars, start the year off pretty strong, soften between May and September, and then strengthen again towards the end of the year. Now we've seen that during what's historically the stronger period of the year, February, March, April, the green bars are this year were quite negative, and now May we're seeing as unusually strong as the market snapped back. January was also quite a strong month heading into the inauguration. So now we look forward to the rest of the year and we say, well, was the summer correction pulled forward this year or not? That remains to be seen, but we are heading into what's historically the weaker and more volatile time of the year for stocks, but we'll see how they hold up. Last year, the red bars, 2024, the market held up quite well through the summer. So we'll see. Are we going to go back to our historical average or repeat 2024? Remains to be seen. We could kind of go either way looking at seasonality at this point. We're now going to move forward and look at world markets. And I talked about how there's been signs of encouragement, but also still some risks out there. And so what we're seeing really with equity markets is they've been climbing a wall of worry. Investors' fear has been subsiding. Equity markets have been on a winning streak. And something we've noticed is we've seen mornings have been soft. We've seen futures kind of down a little bit in the morning and then strong closes. And that's a sign of accumulation. That's a sign of money coming in. That's actually a very positive sign, generally speaking, for markets. It's showing resilience. It's showing strength. International markets continue to attract interest as well. I've mentioned the new all-time high for the DAX recently. Chinese markets have bounced back as well. They led to start the year, got really hammered with the trade disputes, and have really bounced back. Canada has continued to steadily advance in the face of tariff threats and volatile commodity prices. Gold has helped to support the TSX in the weaker times, and in the stronger times, we've seen strength in the Canadian cyclicals, and that's helped. So overall, equities have held up reasonably well over the last number of weeks and have been improved even in the face of negative news. The commodity prices, crude oil and copper, have stabilized. Precious metals also is important, and I'll show this on a chart shortly, where we're seeing that cryptocurrencies, which tend to do better when investors are feeling more aggressive, have been doing better, and precious metals, which do better when investors are feeling defensive, have been underperforming recently. Meanwhile, one other factor that we're seeing out there quite a bit is the U.S. dollar is weakening, and the U.S. dollar has continued to weaken through all of this trade. So even though we've seen ups and downs in equity markets, but the U.S. dollar has been consistently weakening for several weeks and months now. The first thing is volatility in the VIX index. We've seen pull back. Earlier this year, we had a big spike in the VIX, and it was the second highest readings of the VIX we had seen since 2011. So in the last 15 years, the only other time that we saw the VIX get as high as it did recently was back in 2011. That was a time when the U.S. Credit rating was downgraded, and in 2020 during the pandemic. So this was pretty rare, but a very, very big spike in volatility that we've now seen easing in recent months, and the VIX has pulled back more towards its historical average and historical range. If we look at the U.S. against the world over the last 6 months, which is the U.S. is the black line, orange is Canada, and green is international ex-U.S. And we're seeing international markets continue to outperform. The Canadian market is in the middle, and the U.S. has been catching up, but still lagging relative to Canadian and international markets. And interestingly, we're looking at the Dow Jones averages, the three of them. The industrials have been bouncing back. They're not quite positive yet year to date or over the last couple of years, but they're bouncing back. We are seeing that utilities has basically, as the green line, has just been steady for the last year plus. Most of the last couple of years, most of the last year, we've seen the utilities hold steady, and they continue to do so. What we did see back in the winter was a major underperformance by the transports. We've seen an initial rally back, but now that rally has stalled out. And that's important, because if we want to think that the recovery in cyclicals, that the recovery in industrials may continue, then we'd want to be seeing that confirmed by the transports. The initial rebound we did see confirmed by the transports. Now it's starting to fade a little bit and get a little mushy. So we'll see what happens as we go forward from here. Looking at the relative performance of currencies over the last 6 months, we're seeing that gold had a huge run into early April, and in the last month, it's just kind of leveled off. It's been flat to slightly lower and has bounced back in the last couple of days. The purple line is the euro US dollar. Euro has been steadily climbing. It did have a bit of a correction, but overall, it's continued to trend upwards. The green line is the Canadian dollar. It rallied up into April and has been kind of flat for the last month. And the black line is the US dollar, which we see since the beginning of January has been steadily trending down relative to other currencies, and that downtrend has continued. Now, if we look at currencies and equities, what I'm trying to show here is the black line is the price of gold, which as we mentioned, had been steadily climbing and then has flatlined in the last month. The orange line is Bitcoin, and Bitcoin I like to look at as a high octane proxy for investor confidence and investor aggressive. When investors are confident and seeking risk, Bitcoin is one of the places they go, and when they're not, they pull out. And we've seen the green line is the S&P 500, and we can see that the stocks and Bitcoin kind of trend in the same direction. But if you really want to see it, Bitcoin's the one out at the margins. It's the more extreme and the one that shows the bigger trend swings and the bigger signals. But one thing we have seen since the end of March, Bitcoin's been rallying, equities have been rallying, and gold has stalled out. And we can see it in the NASDAQ and strength in momentum, growth kind of stocks. Massive pullback. That was a huge breakdown it had back in February. It bottomed out in April, and in May has been rallying big time. Gold, on the other hand, we can see had a massive rally through 23, 24, early part of 25, has now started to roll down into a correction here. It's currently on a double bottom pattern. The Russell 2000 small caps, again, a sign of where people go when they're more willing to take on risk for potential return, small caps. And we're seeing small caps got hammered in March, hammered in early April, and now they've broken out, they've been recovering, and they're actually back trading above where they were in April and into where they were back in March. So we are seeing, and this is a good sign of breadth as well. It's a good sign of strength of a market that we are seeing strength in the Russell. TSX has actually closed at a new all-time high. We see it bumping up against it here on the point and figure chart. Correction was moderate in Canada, and the rally has been strong, and the long-term uptrend has remained intact. Looking at U.S. dollar CAD, we saw strength in the U.S. dollar in the later part of 24 and the beginning of this year. It rallied right up into previous resistance around 145, 146, and now has started to roll back down again. And it's currently back down below 140. And I wanted to highlight here the BMO China Equity Index ETF. This is an indication of the Chinese market, and it shows us that what I was saying in the early part of this year, China was doing great, had a big pullback correction, and now it's working its way back higher. And most importantly, China bottomed out at another higher low. So this emerging uptrend in China does continue. It hasn't broken out yet, and it still needs to break out of this longer term downtrend, but it's looking more encouraging than it did a few weeks ago. Crude oil, on the other hand, is still struggling. Crude oil had a massive breakdown back in March, April, and below about 64, and it has pretty much remained below that. It did bounce up a little bit off its lows, but crude oil still has more work to do to convince that this is not still a significant downturn in the oil price. I now wanted to show that through all of this volatility, how have we been managing and positioning the portfolios managed by SIA Wealth. So we continue to navigate through volatile markets using our rules-based, relative strength-driven investment strategies. In recent weeks and since our last webinar, the equity action call has returned to the green favored zone, and we have shifted back to a more aggressive stance in terms of equities. We're back at 100%. We're back at full equities. We've reduced cash. We've brought equity exposure back up to its maximum. We've increased exposure to international, Canadian, and U.S. equities, and we've also increased exposure to cyclical sectors within equity markets. So as of May 19th, our portfolio exposure, the first thing I wanted to show here was on the two leftmost columns. I showed the peak amount of cash we raised during March and April and our current cash levels. And we can see that we were between 16 and 40% cash based on the various portfolios. We're now back down to our buffer of approximately in and around 1%, give or take. In the asset allocation fund, which is more of a balanced type fund, it still has its 42% allocation to fixed income. Looking at golds, our gold exposure has declined from its previous peaks. The equity and asset allocation funds are now down back about 5%. The North American Equity Fund, ETF Focus North American Equity Fund, is in and around 11%, and so is the Canadian Equity Fund, 11 to 12%. Golds now. Our defensive exposure has also now come down, depending on the portfolio, mostly between 12 and 24%, a little more in the Global Equity Fund, at about 39%. And then as we look at cyclicals, we can see quite large allocations, 55% now to cyclicals in the tactical global equity, 33% in the asset allocation, 64% to 75% in our equity funds, the North American and the Canadian. And also we can see again on our portfolio exposure based on country that we're fairly somewhat balanced, more balanced than we often are between the Canadian, U.S., and international equity. Our U.S. tends to be more dominant on a historical average, but right now we're seeing, if we look, for example, at tactical global equity, 36% U.S., 18% Canada, but almost 45% in international equity. So we see higher international equity and a little lower than average U.S. equities. So in asset allocation, 20% U.S. equities, 25% international. In our Focus North American Equity Fund, 54% U.S. equities, 35% Canadian equities, 10% in international equities. And I did want to remind everybody that within the last couple of months that we have now introduced for the very first time 10% international equity exposure into the Focused North American Fund and the Focused Canadian Equity Fund. This is new, and this is a new feature that we have added to these funds, is this 10% international equity sleeve, which we have maintained. So looking ahead to the summer, the political environment seems to be improving, and negotiations are underway on a number of fronts, on trade and on conflict and in other areas. So and domestically as well. So the White House has been busy, and they remain busy. And through all of this and the turmoil and the change and the transitions, the economy has been reasonably resilient. The markets have been resilient, but risks remain around negotiations, around the economy, around the disruptions and the uncertainties that we may not have seen completely play out yet, and we don't know what the full impact of that may be. As such, our relative strength indicators have strengthened significantly over the last number of weeks, and we are right now running at full equity exposure and with more exposure to cyclicals over defensives. We are continuing to monitor trends in capital flows and relative strength, and we remain prepared to make additional tactical changes as needed going forward. I'll just finish now with our disclaimer slide. And at this point in time, I would like to thank everyone very, very much for joining us this month. And we look forward to joining you again next month. Hope you have a great day.